Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, October the 22nd, 2025, recording this in the morning. Okay, let's not a huge amount going on in terms of news flow. So I just wanted to have a look at a technical look. Let's have a look at gold and some of these metals here and look at what's going on. So obviously we've had what some people are calling, I guess the correct name when it would be a technical correction. You can see here that not only do we have a big, after these Fibonacci extended moves here, very, very oversold. We all know the story there. We had a huge move down on Tuesday, yesterday, and then also that's followed through today. So the question now, what's going on and why was it caused? I think it was a technical correction, very, very oversold. But we've had increasing strength in the US dollar. We also had the Diwali sort of holiday in India where there's a lot of jewelry traditionally bought, especially for silver, gold, these kinds of things. That's ended. So there's sort of a pullback there. So that's caused the pullback. Now the question really here is where will this stop and will it continue? Now, if we just look here, I've got sort of a Fibonacci drawn from this sort of the most recent upwards impulse from the 20th of August. And you can see here, we're now approaching interesting levels. There's clearly an area of support. This is the 20-day moving average here. So that's an interesting area. I mean, another interesting area would probably be down here at 37.50 or so, which is a more extended sort of a fib. If we actually put on a shorter term fib, let's just put it on a shorter term Fibonacci, just see where there's a bit of a overlay. What maybe this shorter term one, so not from here, but let's say this one here from the 18th of September, and we'll draw it all the way up to the top there. I'll just put that over there, approximately here. You can see that again, this crossover of the 50, we're now at the 50% fib there, which could get down to the 61. So I think this zone in here is looking interesting, 4,040 or down to even, let's say, 3,975, almost around about 4,000. So that's definitely an interesting area there. If we look over at something like the silver, now, remember that silver is a lot smaller market. Has about 9 times less liquidity. So obviously the moves on both sides are sort of exaggerated, so to speak. But again, similar kind of situation. We had a big sell-off actually over the last 2 or 3 days, and then continuing today. Again, getting to an interesting level. If we look at this fib, which I've taken from sort of down here, you could take it from down here or so. Again, down to about the 38%. Now, let's put that again on a sort of a shorter term one, similar to what we just did on gold, and you can see that that's coming down to the 50 or the 68% fib. So the point is here that it's definitely an interesting retracement level, and will this sort of push up a little bit higher? I think possibly. The long-term structural, so this idea of the debasement trade and more fiscal issuance and the dollar losing credibility and all this kind of stuff. I think in a certain sense that still remains intact, safe haven sort of status, and I think that medium-term demand should stay. In the short term, what could determine sort of the risk would be Trump's meetings upcoming with President Xi of China in a couple of weeks, or actually in about a week and a little bit, and potentially the situation, a potential Trump meeting with Putin in terms of the Ukraine situations. But I think the President Trump and President Xi meeting is going to give a sort of a risk on, risk off tone. But probably more importantly as well, in terms of the silver market, is this ongoing investigation, the so-called Section 232 investigation into imports of critical minerals. So not only sort of silver, but also palladium and platinum. Gold seems to be excluded, and that's quite important because if you remember, that had repercussions earlier previously for gold and for copper, and this idea that there may be sort of tariffs imposed on copper, for example, which Trump eventually said no to. We saw that huge dump in copper a few weeks ago. But basically, the issue here is that if the U.S. government, I think it's the Department of Commerce, if they do find that these sort of minerals are critical and need to somehow be tariffed or protected, I mean, metal which is physically in the US would sort of, in a certain sense, like in the COMEX vaults in New York, kind of be stranded because no one would be wanting to import and pay those tariffs. And what would happen is that would start to get that scarcity in London again, at the London Metals Exchange, and there'd be sort of a premium on the COMEX. So that would cause probably silver to rip higher, like even to sort of new highs again, if we get those tariffs imposed. On the other hand, opposite situation. if Trump and the US government decides under Section 232 that no tariffs would be imposed on silver, we'll get the opposite situation so that, there'd be an easing of the tightness at the London Metals Exchange, and that whole short squeeze mechanic would no longer work. And basically, a lot of the metal, which is physically held in the COMEX vaults in New York, would be able to travel across the Atlantic to London, and that would lower that premium. So that premium of the London over the COMEX in New York would shrink, and that would cause a downward pressure. So that's the kind of mechanics of that. So very important we keep an eye on the Section 232 investigation. In the meantime, wouldn't surprise me if these precious metals here just sort of consolidate a little bit, but could find some support here. If we actually look at copper, interesting that copper has come off a little bit. There's been some talk this morning about potential trade deal between the US and India. That's a little bit of a sort of a positive risk for industrial metals here. I don't know how much we can read into that. You see copper here, obviously it's come off a little bit, but not nearly as much as, again, looking at gold or at silver. So copper actually doing okay, considering that its cousins in the metal space has been under a lot of pressure. And if we look here at this fib, we're just at a 38% fib from this recent sort of upwards impulse here. So, in a certain sense, not doing too badly. Just while we're in the commodity space, you can see that oil is up about 2% or $1.20 today. So that's a nice. Now, again, technically, this was a very strong support area. If you look around about this price here, which is about $55.50, and you can see that oil is pushing up. So this could just be a technical bounce, but still we're well below all the moving averages. And you have to say that we haven't yet got back to any sort of Fibonacci retracement. So even if we do a short-term fib here, let's do a short-term one. You can see we're just now on the short-term impulse down, just touching the 38%. If we do the sort of the longer-term one here, you can see there was still quite a far way below that. So this is going to be the next test, 59.5 dollars for sure would be an interesting test, which would also coincide with the 20-day EMA. There's been some talk, again, part of the India US potential trade deal, that in exchange for lower tariffs, India would agree to reduce its consumption or the purchases of Russian oil, which could put a little bit of a premium on the global price there. So we'll see what's going on there. But oil, it does seem technically interesting. What I would point out, apart from what we just said about the fibs and the resistance, is that you do have an interesting trend line just here as well. So let's first of all see if oil can break this. That'll be the 38% on the short-term fib. If it can break that, then that's starting to look a bit interesting, at least for a push upwards for a couple of bucks to 59.5 dollars. Also, what's been happening is that we have seen a little bit of strength in the dollar overnight. Again, interesting, just again, looking technically at the chart. So if I just push it back here and zoom out a little bit, we can see that obviously the US dollar had a big fall for, sort of many, many months, 6 months or so. But it does seem to be finding, this is like a sort of higher lows and some kind of basing formation. Could this go lower? Possibly, but it does seem to be in a sort of essentially a sideways consolidation trading range here. And at this point here, you did have a bit of a retracement. It's now pushing higher. Just from a technical perspective, you can see that it's gone above the 100 and the 50 and the 20-day moving average, now maybe pushing up to the 200. And what I did here, I just measured a couple of Fibonacci extensions. So you see from this one and then from the shorter term one. And both of those measure out, somewhere in the red box would be the target around about here, which does, depending on which one you use, sort of coincide at least with this recent high at about 99.35, which is also approximately the 200-day EMA. So it would not surprise me at all to see the dollar index push up to here and maybe push up to this key level here as well, which is overhead resistance at 99 and 3/4. At that point, we're probably going to have a lot of things. Maybe the US shutdown, government shutdown will end. We'll have a meeting between President Xi and Trump. And also, of course, don't forget that this Friday, in a couple of days, we will have a little data, finally, the CPI number. Now, if that's hot, that could push that up for sure. Otherwise, if that comes in cool, that might just literally cool off the dollar here. So that's something to be looking at. In terms of other markets, We did get this morning softer than expected, lower than expected inflation in the UK. So the British pound sort of coming down a little bit on that. But overall, currencies are a little bit weaker against the US dollar. When we see the euro coming down, you see the Swiss franc, even the Swiss franc, just sort of pausing a little bit, and the Japanese yen. I mean, essentially pretty flat here on the yen. So the currency is not doing particularly well against the US dollar. If we have just a quick look at the bonds, what is interesting is just looking at the bond market. I just want to show you, let's say, for example, the 2 year in the US, which is quite strong. It's grinding higher, but compare that to something like the 10 year, which is really pushing up towards the top of its trade range, or the ZB, which is like the 15 to 20, or the Ultra Bond, which is the true 30 year, which is actually breaking out of this upwards channel. So the question here is, we've got a long end led bull flatten, which is flattening the curve. And that's interesting, because what is that saying? Is that saying that, inflation expectations are sort of relatively anchored over the longer term, that, the economy growth expectations are relatively anchored? Or could it be something a little bit more technical? Remember that Powell said to us a while ago now at his most recent speech that they're happy to let MBS run off from their balance sheet, so the mortgage-backed securities. They're going to stop the QT. So they're going to let the MBS run off, but stop the bond quantitative tightening and maintain the balance sheet as a stable level. So what does that mean? If they're going to let the MBS run off, but they want to maintain a stable sort of balance sheet, that means possibly there'll be more buying or more reinvestment in longer term bonds as opposed to mortgage-backed securities. And maybe that's giving a little bit of a bid. I was reading some numbers talking about maybe 100 billion a month, a little bit of a bid to the long end. Of course, there will be, in theory, a few, less bonds, because, as I say, the Fed is stopping at some time. Powell wasn't specific. Their quantitative tightening. So the point is that they are going to, if anything runs off or expires, they will actually start buying it back, not with the mortgage-backed securities, but with the long Treasury bonds. The other thing as well, which is interesting and maybe supporting the Treasury bonds here at the long end, is the fact that the reality is the U.S. government is starting to collect quite a lot of money from the tariffs, and at the margin that will help the deficit and cause a little less issuance. I mean, it's not a huge number, but that helps a little bit. So you put all these factors together, and that is seemingly supportive for the long end. I mean, maybe the inflation number this Friday will upset that narrative. And just talking about inflation, just want to have a quick look here at inflation expectations here. So give me a second just to bring this up. What I'm going to try and do here is to look at market-based expectations of inflation and just see how they're actually going. So if I go here to macro, I believe I have that. Let's have a look here. Inflation swaps. Yeah. So this is what the market is pricing in for in inflation swaps. Let's just have a look. Hopefully that'll come up. So again, what we can see here is that this is all the different tenors. So if we look at something like the 1 year, it's still relatively elevated at 3.1. But what we can notice, this is a daily chart, is that if we look at, let's say, the last, I don't know, 2 or 3 months, this is falling down. You look here this is the 1 year, then we go on the 2 year, and all across the curve. And you can see that if we look at something like the 10 down the bottom here, that sort of orangey line, and even the 30 year, you can see that first of all, it is a good 60 or 70 basis points below the 1 and 2 year. But like the 1 and 2 year, inflation swaps are actually sort of plateauing and actually heading downwards. So that's the other issue here about the long end of the bond. Again, just look at the 30-year inflation swap. You can see that that's been relatively anchored for the last 3, 4, 5 months, going back to, I don't know, let's call it May, June. It's essentially flat, maybe even down a little bit, and that's one of the reasons why the US bond market. There's been a lot of talk of, inflation is sticky, and that is true at the front for the next year or two. That was quite elevated, but you can see that it hasn't really been the case for the long-term inflation expectation, which is expected, at least according to the market, to go down. So that's maybe one of the reasons that the 30-year is getting a little bit of a bid as well. That inflation expectations, inflation fears are not actually that elevated. Apart from that, just have a quick look here at the equities. They're relatively flat. Let's look at the ES. Again, sorry, let's put it on the December contract here. You can see here This is still a constructive chart. I mean, I know we had the Trump tweet here about China. It's bounced around a little bit, but we are technically still trading at well, we are still trading at highs on the ES, and the moving averages are still all pointing upwards. Even though one could argue that momentum is definitely slowing, but there's still a constructive chart. Similar situation here if we look at Nasdaq trading around the highs. Even the Russell, it's come off a little bit, but not too bad. And if you look over in Europe, Euro stocks trading around the highs. Excuse me, I just grab some tea. So the point is that there's a lot of gloom and doom out on Twitter and places like that, but the reality is that the stock market is still doing okay. Now, the stock market, of course, is not the real economy. There's been some indication that spending is starting to come down in the US, especially the more sort of cyclical areas, retail sales maybe starting to come down a little bit. Consumer discretionary may be coming down a little bit, and for sure that's quite interesting. And maybe this could be an interesting time just to look at some of the sectors. If I look here at the S&P sectors, let's just go through those, just get a sense here. So you look at sort of technology doing well. If we look at healthcare, doing relatively well. Look at financials doing quite well, though it's come off some of that sort of those bank issues. But now we look at consumer discretionary, which is up here. I mean, let's look at consumer staples, which is here. And you can see that's a lot lower. So, it's a mixed picture. It's not clear to me that the US economy is collapsing. On the other hand, it's not clear that the US economy is really sort of outperforming. In the absence of data, that's difficult. So let's just keep an eye on that. And as I say, this Friday we get not only the delayed CPI, we get the University of Michigan survey, which is a little bit doubtful, but hey, it's something. And we also get the preliminary PMI, so S&P Global PMI. That's which the market will be looking at. Okay, guys, I'll leave it there for today. Not no data coming out and not a huge amount of news. It seems so. Maybe we'll get some tweets from you know who. That's about it. Have a great trading day, and we'll keep this going tomorrow. Thank you.